Okay, let's go.
Have you ever just stared at the stock market and felt like it's playing by some secret set of rules that nobody ever told you about? Well, today, we're going to pull back that curtain. We're going to decode the market's hidden logic. Let's get into it.
So let's start with one of the most frustrating questions in all of investing. I'm sure you've been here. A company reports absolutely fantastic news. We're talking record profits, maybe 200% growth. So you buy the stock, you expect it to just shoot for the moon, and instead, it drops. Why? It feels totally backward, right?
Well, here's the wild part. The key to solving this very modern puzzle. It isn't something you're going to find on a news channel today. No, it comes from the writings of a man from over 100 years ago. And that just proves that while technology changes, human psychology, the thing that really drives the market, it stays remarkably the same.
And that man was Charles H. Dow. Now, you've probably heard his name from the Dow Jones Industrial Average, but his real genius wasn't just in creating an index. He was a journalist, a co-founder of the Wall Street Journal, and he spent his days just observing. He realized the market wasn't just a collection of numbers, it was driven by the collective hopes and fears of everyone in it. He was basically decoding its psychology.
So, Dow organized everything he learned into 6 core principles. Now, for this explainer, we're going to zero in on the ones that are absolutely crucial for solving that puzzle we started with, the ones that really help us understand the market's mind.
And that brings us to the first and, honestly, probably the most important principle of them all. It's the idea that the market discounts everything. What that means is, at any given moment, a stock's price already reflects all the known information out there. The good news, the bad news, the rumors, all of it. This right here is the key.
So let's see how this actually works. Let's use an example, say a steel company. Okay, so long before any news hits the press, the smart money, we're talking big institutions that track commodity prices, they see steel prices creeping up. So what do? They start buying that steel stock quietly, causing its price to gradually rise. Then, maybe weeks later, the company finally reports those record profits. That's the public headline. But by then, the price already has that good news baked in. So all the retail investors who are rushing to buy on that headline, they're actually buying from the big players who are now cashing out and taking their profits.
And that's the whole point. The public news isn't new information for the market. It's just the final confirmation of something the price has been hinting at for a while. The stock isn't falling because the news is suddenly bad. It's falling because the party's over. The smart money has already left the building.
You know, this leads us perfectly into our second key principle. See, the market doesn't just zigzag randomly, it moves in trends. And these trends have very distinct phases that are driven by the shifting emotions of all of us, the investors. Understanding this emotional cycle is like having a map to the market's behavior.
So, a major bull market, it unfolds in 3 psychological acts. First, you have accumulation. This is usually after a big drop, when the public is scared and pessimistic. This is when smart money sees value and starts buying quietly. Then comes public participation. The trend is obvious now, everyone's getting excited and jumping in. And finally, you hit distribution. The market is euphoric, the news is amazing, and that's the cue for the smart money to start selling to all the enthusiastic latecomers.
Now this slide here, this is where it gets really fascinating. Just look at the contrast in behavior. The smart money and the public are almost always doing the exact opposite thing at the exact same time. During that accumulation phase, when the public is full of despair and selling out, the big players are buying. Then, during distribution, when the public is overcome with euphoria and buying everything in sight, the big players are carefully and prudently selling. They're operating on logic, not emotion.
And they don't just, wake up one day and sell everything at once. That's not how it works. Large institutional investors are always thinking about their portfolio allocation and managing their risk. They adjust how much they're exposed to the market based on how expensive or cheap things are.
For example, in a market that's valued pretty normally, a big fund might have a balanced portfolio, maybe something like 60% in stocks and 40% in cash. They're still in the game, participating in the growth, but they're also ready for anything.
But look at what happens when the market enters that euphoric, overvalued distribution phase. They're not trying to perfectly time the absolute top. That's a fool's game. Instead, they just systematically lower their risk. Maybe they shift to only 20% in stocks and hold 80% in cash. They are literally selling into the public's buying frenzy, getting ready for the next cycle.
So, with all this going on, how can you tell if a trend is the real deal or if it's just a fake out?
Well, Dow gave us a tool for that too. It's called confirmation. And the logic is simple. For a major trend to be legit, different parts of the economy should all be telling the same story.
Back in his day, Dow looked at two main indexes, the industrials and the transports. And the logic behind it was, well, it was just brilliant. If the industrial companies are making more stuff, then the transportation companies must be shipping more stuff. Simple as that. One confirms the other.
This slide just lays it out perfectly. If both the industrials and the transports are hitting new highs together, that's confirmation. It's a big green light that the trend is healthy and strong. But, and this is the key, if the industrials hit a new high but the transports fail to follow, that's a divergence. Think of it as a huge warning sign that the economic engine might be sputtering and the trend could be in trouble.
And I know what you're thinking. Industrials, transports, that's pretty old school. But this logic is absolutely timeless. Today, you might ask, hey, if pharmaceutical stocks are soaring, what about the companies that supply their raw materials? Are they doing well too? If big IT companies are hitting new highs, are the semiconductor companies that supply them also confirming that strength? It's the exact same principle, just applied to today's economy. So after all of this, it's really important to get one thing straight. Dow theory is not a magic crystal ball. It's not going to tell you the exact day to buy or sell. What it is a powerful mental model, a lens that helps you interpret the market's behavior and understand the deep psychological forces that are always at play.
So let's just quickly recap the big takeaways here. First, remember, the price already reflects the news. Second, the market moves through those psychological phases we talked about. Third, the smart money almost always acts opposite to the crowd's emotions. And finally, a truly healthy trend needs to be confirmed across the whole economy.
If you take only one thing away from our explainer today, please let it be this. The secret isn't in reacting to every single headline or every breaking news alert. The real insight, it comes from stepping back and asking a much bigger question. What is the market's underlying psychological phase right now? Are we in a period of fear, excitement, or are we in total euphoria?
And that brings us to the final question, the one I want to leave you with. Using this framework, looking at the market right now, with all of its headlines and all of its emotions, which phase do you think we're in? Accumulation, participation, or distribution? The answer to that question will tell you a whole lot more than today's news ever could. Thanks for joining me.